Welcome to this tutorial on performance measures, part of the FRM Part I curriculum. In this video, we are going to focus on the key performance ratios that every risk manager and portfolio analyst need to master. The Sharpe Index, the Treynor Index, Jensen's Alpha, the Information Ratio, and the Sortino Ratio. These measures are not just exam topics, they are the tools professionals use every day to evaluate whether a portfolio manager is truly adding value and whether the returns being generated are worth the risk being taken. This is part of the reading modern portfolio theory and capital asset pricing model that we discussed them in another separate video. Let's get started. Before we dive into the topic, let me walk you through what you will be able to do by the end of this video. You will be able to calculate, compare, and interpret all of the following ratios: the Sharpe Performance Index, the Treynor Performance Index, Jensen Alpha, the tracking error, the Information Ratio, and the Sortino Ratio. You also learn the alternative ratios such as modified Sharpe Ratio and M-square, or otherwise called Modigliani measures. These are all testable quantitative learning outcomes directly from the FRM Part I syllabus. By the end, you won't just recognize these ratios, you will know when to use each one, what its limitations are, and how to avoid the traps the exam like to set. Let's start with the big picture. All performance ratios share a common logic. They measure excess return relative to some definition of risk. The formula template is always the same. That is excess return divided by a chosen risk measure. What changes between ratios is how we define risk. This gives us four distinct families. First, ratios that use total risk, that measured by standard deviation sigma, and that is the Sharpe ratio and the M-squared measure. Second, ratios using systematic risk, beta, and those are the Treynor ratio and Jensen alpha. Third, if we care specifically about downside risk, we use the Sortino ratio. And fourth, if we are measuring performance relative to a benchmark, we use the Information ratio, which uses tracking error as its risk measure. There is also a fifth, more advanced family, ratios that are based on tail risk, like modified Sharpe, which replaces standard deviation with value at risk, or conditional value at risk, also called expected shortfall. We will cover all these concepts with numerical examples in this tutorial. Knowing which family a ratio belongs to will immediately tell you when it's appropriate to use. And that logic is exactly what the FRM exam tests. The Sharpe ratio is the most widely used risk-adjusted performance measure in finance. Its formula is straightforward. Take the portfolio's return, subtract the risk-free rate, and divide by the portfolio's total standard deviation. In other words, how much excess return are you earning per unit of total volatility? Look at the example on this side. Portfolio A and Portfolio B earn a 12% return each, but Portfolio A has a standard deviation of 10%, giving it a Sharpe ratio of 0.8. Portfolio B has a standard deviation of 20%, cutting its Sharpe ratio in half to 0.4. Same return, twice the risk. That is, Portfolio A clearly outperformed Portfolio B on risk-adjusted basis. The Sharpe ratio is best suited for well-diversified portfolios because it penalizes all volatility equally, both upside volatility and downside volatility. This is also its key limitation because it treats a lack streak of strong upside return as a bad thing, because it raises volatility. For this reason, the Sharpe ratio breaks down when returns are skewed, option-like, or hedge fund driven. If the return distribution is not approximately normal, the Sharpe ratio gives you a distorted picture. And the exam will, of course, test you on exactly this method too. The Treynor ratio adjusts for a different type of risk, not total volatility, but systematic risk, and that's measured by beta of portfolio beta P. Its formula is as following: portfolio return RP minus risk-free rate return RF divided by beta of portfolio beta P. The question this ratio answers is how much excess return did the portfolio earn per unit of market exposure. In the example here in the right-hand side, portfolio A earns 14% return with a beta of 1.4 and giving a Treynor ratio of 7.14%. Portfolio B, on the other hand, earns a 12% return with a beta of 1.0, which gives a Treynor ratio of 7%. Despite a lower absolute return, portfolio A is slightly more efficient on a systematic risk-adjusted basis than portfolio B. Here is the critical exam trap. The Treynor ratio is only valid for well-diversified portfolios. Portfolios where unsystematic or idiosyncratic risk has been essentially eliminated through diversification. Why? Because beta only captures market risk. If a portfolio still carries significant unsystematic risk, beta alone understates the true risk exposure and the Treynor ratio will overstate performance. For a concentrated or undiversified portfolio, always use the Sharpe ratio instead of Treynor ratio. This is an important point to remember for the exam. Jensen's alpha takes a fundamentally different approach. Rather than asking how efficiently a portfolio earned excess return, it asks, did the portfolio manager earn more than what the capital asset pricing model, the CAPM, would predict given the level of systematic risk taken? The formula is as following. Alpha equals the actual portfolio return minus the expected return calculated using CAPM. That expected return is the risk-free rate plus beta times the market risk premium. We have already discussed these in our previous video. If alpha is positive, the manager delivers returns above and beyond what systematic risk exposure would explain. That excess value is interpreted as manager skill. Consider the example here. If portfolio return is 14%, risk-free rate is 4%, and market return such as S&P 500 is 10%, and beta is 1.2, then using the given formula here, the Jensen's alpha is 2.8%, which is greater than 0 and shows the outperforming of market portfolio that may be due to the manager's skill. Jensen's alpha is independent of total volatility. It doesn't matter how volatile the portfolio was in absolute terms. What matters is whether the manager beat the CAPM benchmark. The key limitation to remember for the exam is that Jensen's alpha is only meaningful if the CAPM or capital asset pricing model is a valid model. If the underlying assumptions of CAPM don't hold, for example, in markets with significant liquidity premiums or pricing anomalies, then the alpha estimate is unreliable. Understand the meaning of different alpha values as shown here in this part. The Sortino ratio was designed to fix one of the most criticized shortcomings of the Sharpe ratio, that is, the equal penalization of upside and downside volatility. The Sortino ratio replaces total standard deviation with downside deviation. This standard deviation is calculated using only returns that fall below a minimum acceptable return, or MAR. This minimum return is normally the risk-free return or any other benchmark return that is defined by the portfolio manager. And the numerical example here, the minimum acceptable return is 4%. The downside standard deviation is computed using only the portfolio return that fall below this threshold. Any return above 4% and the return series are completely excluded from the calculation. Then the Sortino return or Sortino ratio is computed as portfolio return minus the MAR divided by the downside deviation. The result is 1.33. Meaning the portfolio generates 1.33 units of excess return per unit of downside risk. The Sortino ratio is preferred for asymmetric return strategies such as hedge funds, option writing portfolios, or private equity, where upside variability is desirable and should not be penalized. The key acceptable distinction for the exam is this: Sharpe penalizes both upside and downside volatility equally. Sortino penalizes only downside. Whenever you see skewed or asymmetric returns in an exam question, remember that Sortino is the appropriate measure. Information ratio measures the performance of an active manager relative to a benchmark. Its formula is the average active return, that is a portfolio return, minus the benchmark return divided by the tracking error, which is the standard deviation of the active returns. And the example here, both portfolio A and portfolio B generate a 3% active return. But portfolio A has a tracking error of 4%, while portfolio B has a tracking error of 6%. The result is that portfolio A's information ratio is 0.75 versus information ratio of 0.5 for portfolio B. Therefore, portfolio A is significantly managed better. It generated the same return with less deviation from the benchmark. The information ratio is a good measure whenever benchmark comparison is explicit and you want to evaluate how consistently a manager generates alpha. The higher the information ratio, the more reliable and skillful the active management. An IR above 0.5 is generally considered strong and practice. Use this ratio only for active managers, and it's not meaningful for passive strategies with no benchmark. Tracking error, or TE, is the foundation of the information ratio. It's simply the standard deviation of the active returns. That is the difference between the portfolio return and the benchmark return over time. The higher the tracking error, the more the portfolio deviates from the benchmark, and the more active the management style. Here is an important exam tip. If the tracking error equals 0, it means the portfolio perfectly replicates the benchmark. There are no active bets, active return is approximately 0, and mathematically the information ratio is undefined. That's why you cannot divide it by 0. This scenario describes a positive index fund, not an active manager. In practice, a low tracking error is not always good or bad. Rather, it depends on whether the manager is intentionally passive or is simply failing to generate any differentiated views. The exam will test your ability to interpret tracking error and context alongside the information ratio, and it is very rare to ask you to calculate the tracking error from raw data. So interpretation is more relevant for the exam. The M-squared measure developed by Franco and Leah Modigliani, both of them are Modigliani, and that's why sometimes this measure is called Modigliani. It takes the logic of the Sharpe ratio and converts it into an intuitive, directly comparable return figure. The core idea is that what return would this portfolio have earned if it had been scaled up or down to match the market's level of total risk. The formula is M squared equal to risk-free rate plus Sharpe ratio multiplied by the market standard deviation. Importantly, M squared is not a ratio, it is a return expressed as a percentage, which makes it far easier to communicate to investors and clients than an abstract ratio. And the example here, the portfolio has a return of 12%, risk-free rate is 3%, the portfolio standard deviation is 10%, and the market volatility is 15%, and the Sharpe ratio is 0.90. Plugging into the formula, M squared equals 3% plus 0.90 times 15%, which gives us 16.5%. The interpretation is that if this portfolio were leveraged or deleveraged to match the market's volatility, it would earn 16.5%, which is above the market return of 15%. So the portfolio outperformed on a risk-adjusted basis. If M squared exceeds the market return, you outperform the market, and if it is below the market return, you have simply underperformed. Sometimes you are tested in the exam without asking you to calculate M squared. Instead, you are asked to interpret the result of a performance measure such as the one we mentioned here, or just you should derive it from another calculations. So it's imperative to understand the logic of this measure for the purpose of exam. The standard Sharpe ratio rests on two key assumptions: that returns are normally distributed and that risk is fully captured by standard deviation. In the real world, however, particularly in portfolios involving derivatives, structured products, or concentrated exposures, these assumptions often fail. Returns exhibit fat tails, negative skewness, and extreme events that standard deviation simply cannot capture. For these situations, we use tail risk-adjusted performance measures. The modified Sharpe ratio replaces standard deviation with value at risk, or alternatively with CVaR, the conditional value at risk, also known as expected shortfall. CVaR is the more conservative choice as it measures the average loss beyond the VaR threshold, not just the threshold itself. And the example here, portfolio return is 10%, the risk-free rate is 2%, and the monthly 99% VaR is 5%. The VAR-based ratio equals 10% minus 2% divided by 5%, which gives 1.60. The interpretation is that the portfolio earns 1.6 units of excess return per unit of tail risk. When the exam mentions fat tails, non-normal distributions, or extreme losses, this is the family of ratios to reach for in the exam. Let's now consolidate everything into a single reference framework. Each ratio we have studied differ in which type of risk it is used and when it is most appropriate to apply. The Sharpe ratio uses total standard deviation and works best for well-diversified portfolios, but breaks down when returns are skewed. The Treynor ratio uses beta and is also designed for diversified portfolios, but fails for concentrated holdings. Jensen's alpha uses beta to isolate manager scale, but assumes capital asset pricing model CAPM validity. The Sortino ratio uses downside deviation and excels with asymmetric or hedge fund style returns. The information ratio uses tracking error and is purpose-built for active manager evaluation against a benchmark. M-squared uses total standard deviation like Sharpe, but presents the results as an intuitive return percentage. And finally, VAR-based ratios are the correct tool when fat tails or tail risk are present. When you approach an exam question asking which ratio to use, always start with two questions. Is the portfolio diversified? And are the returns approximately normal? The answer is will point you directly into the correct measure. Let's close with the exam tips that will save you marks in the exam. These are decision rules. If you internalize them, you can answer most FRM performance measure questions in seconds. First, if the portfolio is not diversified, do not use Treynor. It will give you misleading results because beta understates total risk. Second, if returns are skewed or asymmetric, Sharpe is misleading. Switch to Sortino. Third, if the question involves benchmark comparison or active management, the answer is the information ratio. Fourth, if the question asks you to assess manager skill, Jensen's alpha is the right tool. Fifth, if the question asks for the best intuitive or most communicable measure, that's M-squared or the Modigliani measure. And sixth, if the question mentions fat tails, extreme losses, or non-normal distributions, reach for VAR or CVaR-based ratios. That wraps up our tutorial on performance measures today. Make sure you can calculate each ratio by hand and interpret the result correctly in context. Let me know in the comment below this video if you need more numerical examples or more details of any concept in this tutorial. And of course, don't forget to do the exercises related to this part in the link given in the description. You find a detailed exam style questions along with detailed solutions and exam tips in this exercise that make you ready for sitting for a successful try. Good luck on your FRM exam, and I will see you in the next video. Thank you very much.